Accounting for inventories. And this module is about calculating cost of inventory under FIFO, first in, first out method and weighted average method using perpetual system of accounting. In the earlier module, we have already discussed the periodic system of maintaining inventories. And if you do remember, we have already worked out the cost of inventory under the first in, first out method and weighted average method by using periodic system of accounting. So in this module, the practice question would remain same and our focus would be on the perpetual system. Okay, well, when we say perpetual system, you know that the transactions are recorded on daily basis, mean on date sequence basis, and after recording each transaction we have a balance with us. By the way, under the periodic system we had this working. The FIFO method was giving us closing inventory cost of rupees 8,000, whereas weighted average cost method was giving us 6,847 by using periodic method. When we use perpetual system, this perpetual system asks us to record each transaction just as if we are maintaining our ledger account. You can see that there is a table in front of you. In this table, there is a column for date, there is a column for particulars, and there are three columns: received, issued, and balance. So when we say received means you can say debit side of the inventory account. When we say issues means the credit side of the inventory account, and it is the balance column. If you do recall, there were two methods of maintaining ledger accounts. One was T account method and the second one was running balance method. So this is the same running balance method style. But here, since we are maintaining inventory and we also have to record its quantity and the amount, so we have further divided the received column into three parts: quantity, rate and amount, quantity, rate and amount. Issued column is also divided into three parts, and the balance column is also divided into three parts: quantity, rate and amount. Okay, well, let's start. So on 1st of January, if we look into the question, there is an opening balance of 400 units at rupees 4 each. So here we go. It is opening balance with us. So put this opening balance over here. The next transaction is on 5th January, and we have 1,000 units purchased for 5 rupee each. So just have a look that we are buying 1,000 units for 5 rupees each, total amount 5,000. Okay, so how we will present this in the balance column? Here we go. So in the balance column it would be like this, that 400 we will bring down from the previous balance like this, and 1,000 will be coming up over here. Okay, well, so next comes, there is an issue of 700 units. If you keep that question in front of you, since you have that slide with you, keep that slide in front of you and see, we have 700 units in issue, and how that 700 is worked out. This 700 unit, since we are following first in, first out, this 400 will be taken from the first in, this 400, and to make it equal to 700, 300 will be taken from this lot of 1,000 at the rate 5 each. So you see, 400 altogether gone, issued, and 300 at the rate 5, 1,500. So balance left out of this 1,000 is 700 at the rate 5, and the total amount 700 times 5 is equal to 3,500. Well, this is the balance we have with us now. So next is again on 15th of January, we are buying 1200 number of units at the rate 6 each. So total amount comes to 7,200. So how much is the balance with us? Yes, this 700 we have to bring down at that rate. Okay, agreed. And this 1200 will be shown over here now. So altogether, this is the amount of balance with us in the frame. Okay, well, what happens that on 20th of January, we are selling 1,000 number of units. So how we will make up this 1,000? 700 we have first in, that will be first out. Okay, and to make it equal to 1,000, 300 will be taken from the second lot at rupees 6 each. So total would be 700 at the rate 5 and 300 at the rate 6. Now out of this 1200, when we have issued 300, the balance is with us 900 units. Okay, at the rate 6. And this is the amount 5,400. Next purchase is 800 units at the rate 7 each. Amount is 5,600. Okay, well, and here we go. 900 we will bring down like this, and 800 will be put in the balance column. Like, I believe now you are very much confident that how to prepare this perpetual system based ledger account for inventory. Okay, so we are using first in first out method, and we are following perpetual system of accounting, and we are working out cost of inventory. All right, next is issue of 500 units. We have sold 500 units, means from the inventory, from the storeroom, we have issued 500 number of units to the customers. Okay, so the cost of these 500 number of units will be worked out under first in first out method by taking it from this lot of 900. So because it is first in, so 900 minus this 500 gives us 400, and this remaining 400 will be multiplied by 6, 2400 with us, and this 800 is still unused, will be put in the balance. So altogether we have balance of 1200 number of units. The total cost is 8,000 rupees, and same was the cost of inventory under the periodic system by following this first in first out method. Okay, let's see that what we have with us under the weighted average costing method. Okay, the same perpetual system of accounting we are following, and we are working out cost of inventory, and the method is weighted average. The opening balance remains same, 400. All right, and this 1,000 number of units we are buying at rupees 5 each. But now the thing is that this 400 and 1,000 will be clubbed together like this. 400 plus 1,000 is equal to 1,400. And this 1,600 plus 5,000 is equal to 6,600. Okay. Now, the thing is that we have to calculate weighted average rate. And here we go. This 6,600 divided by this 1,400 gives us 4.7142. So this 4.7142 will be placed over here as a rate. And when we will be issuing 700 number of units, this rate will be used. And the total cost of this issuance is 3,300. So the remaining 700 units will be placed in the balance at the same rate, and this is its closing balance. All right. What happens now? We are buying 1,200 number of units at 6 each, 7,200, and total is 1,900. And this 3,300 plus 7,200 is 10,500. Yes, that's it. And here we go. We have to calculate its cost per unit by dividing this 10,500 with this 1900 here. Okay, got it? This is 5.5 to 6, and this issuance will be made at 5.5 to 6, so that our cost of issuance is 5,526. So out of this 1900, 1,000 has been issued, left is 900, the same rate, and this is the amount. By multiplying this 900 with 5.5 to 6, you get this amount. Your calculators should be very fast. Okay, great. So this is the amount of purchase. 800 units we purchased at 7 each, 5,600. Total 900 plus 800 is 1,700. 4,974 and 5,600 is 10,594. And here we go for its calculation of unit cost. 10,594 divided by 1,700, okay, gives us 6.22. And this issuance of 500 units will be made at 6.22, which gives us 3,110. So after doing this, our closing balance is 1,200 units at the rate 6.22, and the amount is 7,464. So this is what we now understand, that how to calculate cost of inventory under the periodic system and under the perpetual system by using first in first out method and weighted average cost method. So the important tips to remember in this module are that FIFO, under this FIFO method, balance column will contain inventory count in chronological sequence, okay, because we are using perpetual system, and in this perpetual system, whenever we will be writing the balance, it will follow the chronological sequence, okay, the previous balance will be brought down. Whereas under this weighted average method for this perpetual system of accounting, the balance will contain total number of the inventory in hand on that date with its total cost. Okay, so enjoy the module. Thank you.